This lesson is called Beginning Operations. Once a business has secured its financing, and once it's incurred all of its startup costs, which can be long-term investing activities or it can be short-term operational uses of cash, then it's in a position to open up its doors and begin selling. In our example, we have opened a bike store by contributing $40,000 rather to finance the business from the owner's personal investment, and it received a $210,000 loan from the bank. Now, after obtaining the financing, let's look at last period's video. Video 6, you recall, was called Financing the Business. After incurring the startup costs of buying the building and buying rent, paying for advertising, and then also buying inventory, in this lesson called Beginning Operations, we're going to actually sell some bikes. And so by looking at last period's spreadsheet or database, we know that the company started with $40,000 of cash. It got another $210,000 of cash from the bank. The business bought $180,000 worth of building. It bought $2,400 of prepaid rent. It bought, let's see, what did it buy? It also bought $10,000 worth of inventory. And it also incurred a $1,000 expenditure for, I think we bought some advertising. And so I'm putting all the numbers here, but let's label this now. This is our cash column. This is our building asset column. This is our prepaid rent column. This, of course, is our inventory column of bikes. This is our notes payable. This is our equity contributed. And the far right column is called equity earned, E-A-R-N. That equity earned, equity contributed. And of course, with every transaction, our assets must always equal our liabilities plus our two equity accounts. That fundamental identity must always hold. Now, let's say during the first month, the company sold all $10,000 worth of bikes. When we said goodbye to the bikes, we would remove the bikes from inventory by subtracting the asset, and we would subtract $10,000 from equity earned. This is called cost of goods sold expense. It's a reduction of equity earned. And if we sold bikes for $10,000, let's say that for every bike that we bought, let's say it was a $1,000 bike, that we sold it for $3,000. That means if we owned 10 bikes at $1,000 each, that would be a $10,000 inventory. If we sold all 10 bikes for $30,000, 10 bikes times $3,000 each is $30,000 increase in cash, and our equity earned would go up $30,000. An increase in equity earned from the sale of goods or services is called revenues. So look, folks, when we began our operations, we sold our bikes, 10 bikes at $1,000 each, and we sold them for $3,000 each. So cash went up $30,000, equity went up $30,000. Inventory left the premises of 10, equity earned went down 10. So if you net these two numbers right here, we would have what we call a $20,000 gross profit on the sale. Now, in the next video, we're going to add up all of the balances in our asset accounts. We're going to add up all of our liabilities and equity to make sure we balance. Then we're going to adjust our books to make sure that any wear and tear on the building or any rent that may have lapsed is adjusted. This ends video 7, Beginning Operations of our Business.